So I'm going to explain our option trading strategy. It's very simple. Basically, the strategy, we're going to write down here, option trading strategy. And the option trading strategy is very simple because all we're doing is basically selling options, what they call out of the money. So we call them out of the money, or OTM. An out of the money option simply means that if you're selling a call, you're selling it above where the market currently trades. And if you're selling a put, you're selling it below where the market currently trades. So if the market currently trades about $100, you're going to be selling puts that are less than $100. And for calls, you're going to be selling them above $100. Okay, and for calls and puts, there's a premium on these options, so you might sell, let's just say, what we'll actually do is we'll sell, for an example, just 150 call, and we might get $1 for it. That's our premium. And for a $80 put, we might get $3 for it. Okay, so this is the money we collect. We collect at the minute we sell it. We collect $1 plus $3, we get $4. All we have to do is make sure that the market doesn't trade above 150 or below $80 on options expiration date. So how we place a trade is basically there's an options calendar, and we're going to sell our options somewhere, probably maybe 30 to maybe as close as 15 days out of the time when they expire. So they expire, options expire every third Thursday. Okay, and so of each month. So every third Thursday of every month is what they call an option cycle. So there's 12 cycles a year. If you sell 30 to 15 days before that, and then hold through options expiration, and then the market doesn't trade above or below where you sold, you make your max gain, which in the case before was $4. This $4 here. You only have to sell those and carry that risk for that 30 to 15 days. I'm going to bring up a chart that's going to show you calls and puts on two different sides of a column where there's prices in here. Price 1, price 2, price 3. So this is basically the price the market could trade at. And these are the calls and the puts and what their actual values are. There'll be a bid and the ask price on each side, and it might say it's $1 by, say, $1.20. So if you go to sell it, you're going to get $1. If you buy it, it's $1.20. Same thing over here. This price at price 1 will be, let's say, $1 for the put by $1.20. So what we're going to do is we're going to look for calls that again are above where the market trades and puts below where the market trades, and sell them. Okay, so we brought up the SPX, or the S&P 500 index. It's one of the 3 indexes we trade. We also trade the RUT, which is the Russell 2000. And we trade the NDX, which is the NASDAQ 100. Very liquid options and decent size. In other words, we can get a large quantity of money without having to trade a large quantity of contracts. So I'm going to go through this really quick. If I go too deep, it's going to go over everyone's head. So I just want to keep this simple. That when you bring up with they call an option chain, you see the price of the underlying, which is this index, the S&P 500, and then you see where the white and the green meet is basically at that price. Those are basically determines if the stock is out of the money, these white areas, or if it's in the money, meaning it's in the green areas. Just change the color. So we don't want to trade anything in the green areas because that's where these stocks already have, or the options already have value based on where the index trades, the underlying index trades. We want to trade things that are out of the money. So we're going to be going and selling things in this area and in this area. We look at where there's a probability of being in the money at a low level. Here we see things around 11 or 11%, 9.5%. Here you see things where it's 15%, 16%. So we would actually shoot for something even lower priced than these 1895s or 1900s. Okay? And what we're doing is we're just going to collect the premiums that we actually see here. So if we sell these at $5, that would be great. And if we sold these at, say, $2, that would be great. And we would collect a total of $7 in a 30-day period. And the only thing you have to have is a lot of cash in your account to be able to do that, because the brokerage is going to keep a larger money in reserve in case the actual market does move above this 2010 area or this below this 1895 area. That's a quick and easy way of explaining what we do. We do things a little bit more sophisticated. We do protect some of our risk beyond. So if the market does move below 1895, and if it does move above 2010, we don't have unlimited risk on these two areas. So we don't actually collect the full $7. We might collect $5 of this. But those are just details on how we trade. When you bring up something in your account, I can show you kind of what it looks like. You'll see these spreads. You'll see these sold and bought puts or calls, what we sold them and bought them at, and we're just hoping basically that they all expire worthless. Okay, so now I'm going to explain a little bit about how these are actually traded and the profits we expect, and why we get questions all the time. Why do I need so much cash in my account to generate the types of returns that we're getting, and what is this about options that make it special where we have to keep large amounts of cash in our account? So you're going to look at a typical account or we have here, and you're going to see huge numbers that, like, wow, this is impressive. Like, the person has a net liquidation value. That's what the account is actually worth if they were to liquidate it, $321,000, whereas they have buying power with all the margin of $2 million. So you could actually leverage, you can use options, you can get really bullish or really bearish on the market and use much more money that's in here. But that's not the purpose of what we're doing. We keep large amounts of money in cash. Here we have, let me just highlight this again, for $310,000 of $321,000 is in cash. Why is it in cash? Because it's used up in margin requirements. I didn't open up that little slide here, or this piece of the puzzle, but I'm going to, rather than just give you some numbers, I'm going to show you how we derive it. So, as I explained before, we sell puts and calls either below or above the market. In this case, we're going to look at, because we looked at it before, we looked at the SPX, we're going to look at this last put spread here, where we sold 25 puts at 1890, and we bought 25 puts at 1880. As we saw before, the market's settling for about 1960, so these expire worthless on June 19th, 2014, or expired worthless on June 19th, 2014. So when we sold this spread, I'm going to highlight this for you. When we sold this spread, we sold it for a profit of 50 cents. And that's $2.11 we received for the 1890s that we sold, and we had to buy the 1880s as protection for $1.61. So according to my calculations, that's 50 cents that we received as a credit into our account. Now, the spread here is $10 wide. Everybody see that here, where it's 1890 by 1880. That's equivalent to $10 in the index. So we sold 25 of these spreads. So I'm going to write some little numbers up here and explain to you how this actually works out. So we have 25 spreads, or 25 put options that we sold, and we bought 25 in protection. That's the spread. 25 times the $10 wide times the 100 that each contract, each one of these 25 contracts represents in underlying SPX shares. So that there is the equivalent of $25,000. We're going to look at what we got in return. We got 50 cents times the 25 times the 100, and that's going to give us $1,250. And we can make this a heck of a lot easier and just cancel out the 25, cancel out the 100, cancel the 25, cancel the 100, and say for every $10 we put at risk, we got 50 cents. $10 risk, we get 50 cents profit, which is a return of 5% in, like I said before, about 30 days. So what happens is the broker keeps this $10 in risk in cash in your account. So to earn this 5%, you've got to keep large amounts of money in cash in your account so we can sell spreads against that cash. I hope that clears up any questions people have. If not, let us know and we'll discuss how we actually do this in more depth. Thank you.